Welcome to episode 11 of our educational series on 1031 exchanges. Be sure to watch our series on passive real estate investing basics and real estate taxation basics. We also encourage you to read our book, How to Retire from Being a Landlord, which you can order for free on our website or on Amazon.
As the saying goes, if it sounds too good to be true, well, you know the rest. In this case, we're talking about a tax deferral strategy being marketed under the trademark Deferred Sales Trust, which conveniently has the same acronym and shares a word with the well-established Delaware Statutory Trust. Although you will not find the term Deferred Sales Trust in the Internal Revenue Code or IRS regulations.
The pitch for the Deferred Sales Trust goes like this. First, instead of selling your property directly to a real buyer, you sell it to a third-party trust. But rather than paying you cash, the trust gives you an installment note with a promise to make payments in the future. Now, right off the bat, there is the practical issue of your loan. Under the terms of your loan agreement, you cannot simply transfer title of your property to another party. At this point, you no longer own the property, and it will not qualify for a step-up in basis when you pass away.
After the transfer, the trust sells your property to a bona fide buyer, and now your trust is holding cash instead of a rental property. Supposedly, it's perfectly fine that you're directing all of this to happen, even though the trust is ostensibly at arm's length.
And now that all that cash is sitting in the trust, whoever pitched you on this idea gets to charge fees for reinvesting the money in assets that may bear no resemblance to the real estate you own.
And you will have to pay tax on the installment payments you receive. Unlike a 1031 exchange, the Deferred Sales Trust merely stretches out your tax obligations for a period of time. In a 1031 exchange, you can defer all capital gains taxes until you die, and then pass the property to your heirs, subject to a step-up in cost basis, effectively eliminating the tax-deferred bill.
According to the folks behind the Deferred Sales Trust, their network has gathered over $1 billion of assets in recent years through this approach. Admittedly, that's a nice chunk of change for a strategy that has never been formally recognized by the IRS.
I suppose, but hundreds of billions of dollars have been exchanged every year via 1031 exchange, which has been around since 1921, and employs an entire industry of escrow, tax, and real estate professionals. More specifically, 1031 DSTs are a structure based on an IRS revenue ruling in 2004. And today, several billion dollars are invested in 1031 Delaware Statutory Trust properties every year. If you would like the potential to avoid and not just defer capital gains tax upon selling a rental property, all while freeing yourself of the burdens of active real estate ownership, 1031 exchanges continue to be a proven, legitimate, and reliable strategy.
Thank you for watching. Please be sure to watch our other education modules and visit our website at 1031capitalsolutions.com.